Hello, I'm Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report. We have a great show for you this Sunday morning. Of course, send us your questions to Brian Rezny at ReznyWealth.com, and make sure you visit our website, ReznyWealth.com. Download any of our groundbreaking reports about retirement security, income planning, why annuities are dangerous to your wealth and retirement. Find out the facts, how to pick the right advisor to manage your wealth, and a whole lot more. You know, I want to talk a little bit today about market volatility. We're getting a lot of questions, not only in my TV shows, but also my radio shows about market volatility. Let me explain what market volatility is. Unfortunately, most investors think the only investment that goes up and down is the stock market or equity market, and that's simply not the case. All assets that you invest in have the chance to fluctuate in value. That would be the bond market or bond investments, real estate, gold. All investments can go up and down, and often most assets you invest in inter-year throughout the year might change 2 to 5 or 10% negative before they have a chance maybe to come back and go positive or maybe go down more. All investments fluctuate, but unfortunately, most of the investments you hear about on TV all the time, because it's more hyped up to me and sensationalized, is really the stock market or equity market. But ultimately, volatility is here. The last couple years, 2016, 2017, we've seen very little volatility. That's not normal, but we're starting to see more volatility, or what we call normal volatility, in 2018. What I feel the biggest risk to you, the investor, is really the bond market, though. The bond investments. Interest rates are starting to get pushed up. Bond values are going down. A lot of investors this year experience negative returns so far year to date in their bond investments, or you're going to see more losses. Remember, bonds can go down a lot. Depending what kind of bonds or bond funds or bond investments you own, you could lose 20, 30, 40% of your wealth when bonds go down in value as interest rates slowly go up. I will tell you, investors are looking at it wrong. We've put together a special report, The Death of Bonds, available on my website. I would suggest you go there and download it. If your broker or advisor has you in the old school asset allocation, 40% in bonds, 60% in equities, sorry, that doesn't work in this environment. Be prepared to lose a substantial amount of your net worth if you own bonds, bond funds, bond ETFs, or any bond investment if it's the wrong type and or duration. When is it time to move on? A question I get often when we have new potential clients come into one of our offices. Often the first question somebody will ask us when they're interviewing my firm to manage their wealth is, when is it time to move on, Brian? And I always try to explain, most investors kind of have a sense that they haven't done well with their current advisor or broker. They've had the suspicion for many, many years. Often they learn the real value of money management from my TV or radio shows. They get a little more educated and they start to question the direction of their portfolio. Investors put up with mediocre advice too long, and that costs you dearly. Let me explain. When you come and you talk to a firm like Rezny Wealth Management, and we find out and we look at your overall portfolio, we review what you're currently doing, and we ask a lot of hard questions. One of the questions often comes up is, your portfolio hasn't done well for years. You've made a comment that you've questioned the advice you're getting from your current advisor, but you've gone on with that person for 6 or 7 or 8 years. Most people tell us change is hard, and I understand that. But if you put up with mediocre advice or bad advice, most people will put up that for far too long, and it will cost your retirement security dearly. Conflicts and being sold inferior investments rob your returns and rob your retirement. Remember that. The longer you wait to make a change, the longer it's going to take to get you back to where you should be, and the more costly it's going to be for your financial security. Change is good when it is necessary. I know change is difficult for most investors. In fact, we recently had a client couple in my office. And one of the points that we talked about with that particular couple is, are you willing to change advisors? They came up with all the reasons their advisor was not doing a good job. They were not happy with the returns. They realized they were sold various annuities. They realized a lot of the bonds they were sold were marked up and they were basically mismanaged. They realized that they were under-diversified. They had no risk management strategy. They told us all of this information in probably the first 10 or 15 minutes of our conversation. But we came back to them and said, are you willing to change advisors if it's going to help improve your financial situation? And the husband hemmed and hawed. And I said, you're hemming and hawing about making a change, even though you've just told me your advisor's done a mediocre or poor job. How much does that cost your retirement? Remember, folks, change is good. It's easy when you work with a firm like Rezny Wealth Management. Procrastination is costly to your wealth and financial security. We all want to procrastinate. We all want to wait till tomorrow. I often will get phone calls at our office and people that will schedule appointments with our firm to get a second opinion and discuss our management services versus what they're currently receiving. They often have listened to my TV or radio shows for 6, 7, 8, or longer years. They realize a lot of what we're talking about are things that they're not currently doing or taking the opportunity of. And I'll ask them, why did you wait so long? And often they will tell me, Brian, just like you say in your show, I procrastinated far too long. We should have come in years sooner. Don't procrastinate. If there's an issue, you've got a concern about your portfolio or the advice you're receiving, it's better you hit it early and get a second opinion so that you can properly protect your money. Hire a real advisor to manage your wealth, not a salesman. I see too many investors settle. They settle for a salesman under suitability. At the end of the day, you as an investor should never settle for bad advice. Hire a real investment advisory firm, a fiduciary firm to help manage your wealth. If the advice you're getting is not working, never, ever settle. Remember, visit our website, ReznyWealth.com. Download any of our groundbreaking reports. I'm going to go to some questions after a short break, but go to ReznyWealth.com. Sign up for a second opinion. Remember, procrastination is costly. It's dangerous to your financial security. Look at Rezny Wealth Management to give the advice you need to make sure you stay ahead of the game. I'll be right back with your questions after this. Hello, I'm Brian Rezny, president of Rezny Wealth Management. Is your so-called advisor really just an annuity salesman? Fact. Annuities are sold by misleading you, the investor. Sky-high expenses, crazy surrender penalties, and mediocre investments rob your returns and rob your security. My advice, stop being sold. If you want real money management, real advice, call my firm today. Hi, this is Brian Rezny. We're back. We're taking your questions. Make sure you send your questions to Brian Rezny at ReznyWealth.com. And don't forget to go to our website, ReznyWealth.com. Check out our various TV show schedule and also my live radio show, not only on Saturday, but Sunday mornings. Check out all the information we offer. It's free, quick download. Educate yourself a little bit. In our opinion, that'll help protect your retirement and your portfolio from bad advice. Frank in Florida, please comment further about REITs. Are all REITs bad to have for the next 3 years? Frank, excellent question. First off, folks, REITs are real estate investment trusts. These are typically sold through brokerage firms, and there are two types of REITs. There's non-traded REITs, meaning these are not liquid. These are the ones often sold by brokers or brokerage firms. I always warn against never ever buy a non-traded REIT, because you can buy a traded REIT, a real estate trust, that you can buy and sell anytime you want. Your broker doesn't like those, though, because they don't make really any commission on selling you a traded REIT versus a non-traded REIT. Non-traded REITs lock your money up, and when the game changes, meaning you need to sell because your investment's going south, it's going down, you can't because your money's locked up. It could be locked up for 10, 15, or 20 years. Your broker usually won't tell you that until it's too late. But generally speaking, real estate investment trusts act very much like long-dated bonds. I've talked about REITs for a number of years and avoiding those, and I'm glad to say that we've been spot on. Real estate investment trusts, especially publicly traded, haven't done all that great. And I think the next 3 years or so, as interest rates slowly start to move up, as the economy does better, REITs tend to not do that great in a rising interest rate environment. So I would not own real estate investment trust traded, and I would never ever be sold a non-traded REIT. Unfortunately, if you're working with a brokerage firm, whether it's a Wall Street firm, bank, or an independent broker-dealer, there's a chance that they do sell non-traded REITs. Buyer beware, because once you get into these, you can't get out when it goes south, and that's a big problem for your net worth and your retirement. James from Naples, Florida. Was there a stock market bubble? James, I'm not exactly sure what you're talking about. If you're talking about a stock market bubble now or in the last few months, I would say absolutely not. Stock market bubbles often happen when you have overvaluation. So the overall stock market is not overvalued. In fact, if we look at earnings, PE ratio, let's say the S&P 500, for this calendar year, we're trading at about an 18, maybe somewhere in a little bit less than that range, 18 PE ratio, based upon this year's numbers. That is not really a bubble territory. If you remember back to the year 2000, the S&P was trading at about a 35 to 38 PE ratio, almost double what it is today. Corporate earnings are on the rise. Corporate revenues are on the rise. We see good earnings for 2018. And ultimately, we don't see a bubble in the equity markets. Now, you're going to see some volatility that I talked about earlier. That's normal. The big key is this. If we do get to a point in time, and I'm not saying it's going to happen this month or in the next 3 years, but we're going to have another recession. If you do not have a risk management strategy, which most investors we find do not, nor does their advisor, when a recession comes and we have clear signs of recession, you want to start reducing risk in your portfolio. So ask yourself this: do you have a risk management strategy to reduce risk when the next recession comes, not normal volatility, or does your advisor? If neither one of you have that, or your advisor tells you, no, we hold on, we're asset allocators, you got a big problem ahead of you in the next recession. Tom from Fort Myers, Florida. My portfolio, approximately $1 million, has 3 different accounts consisting mainly of stocks with approximately 15 stocks in each. While it has done well of late, my concern is when to sell. Tom, excellent question. What I typically find is this. Individual stocks will be very volatile, more volatile than utilizing, let's say, an ETF, an exchange-traded fund. So I think, first off, your portfolio is overly concentrated in just 15 stocks, and you're probably seeing a lot of volatility and no extra return given that volatility. So that's point one. Point two is, why did you buy these 15 stocks in the first place? What was your research? The exact opposite of why you bought them. If you did real research, and I will be brutally honest, most individual investors who manage their own money do no research on what they buy and put in their portfolio. They buy things like Facebook or Google because they heard of it, or Apple just because it's going up, but when it goes down, they don't know when to sell. A sell strategy is almost more important than a buy strategy. Ultimately, the reason you bought those stocks, if you did real research and you have a real strategy, the exact opposite would come around, and then you would want to be selling those stocks because they're no longer of value and there's better opportunities. Again, most investors that we talk to that hire my firm, individuals that do it themselves, ultimately have done a poor job, have no strategy, and really haven't done research on their investments. Many of them tell us that, and that's why they come and hire our firm, because they realize managing your own money is a difficult task. The other half of the people that often hire our office is also the same reason. They're working with a brokerage firm, a bank, or an insurance company, and they realized their current advisor wasn't really managing the money at all, or maybe they did a bad job. So again, it might be prevalent in your situation or not, but at the end of the day, what is your strategy? Do you follow the strategy? And every strategy must have a risk management strategy in place. If yours does not, you subject yourself to huge losses in your portfolio because you're not going to sell when you need to, and that's going to obviously ruin your financial security. Bill from Marco Island, Florida. What do you think of oil investments like Exxon? Bill, generally speaking, I would avoid oil completely, Exxon included. Oil in general has been decimated in the last 3 years. We had oil prices in the 110 area a little over 3 years ago. They're currently right around $60. I've talked about oil a lot. Oil prices are low, and they're going to stay low, in our opinion, because of us, the U.S., becoming energy independent. Oil prices would have to go up to the $80 or $90 mark, which I do not see, because we're getting flooded with oil in our country, and we're going to get to the point where we're energy independent on oil and natural gas completely, probably in the next 3 or so years. And we potentially will be an exporter of this energy as our supplies grow. That is good for U.S., and it's good for the world, cheap energy prices. If you own Exxon, I would be a seller. If you own oil stocks in general, we don't like them. I think oil as an investment and as a sector is going to be a poor performer, and I would think seriously about not owning oil or any oil investments at all. Sandy from Fort Myers, Florida. Should you make an IRA contribution after age 65? Great question, Sandy. It all depends. If you are actually still working, Sandy, and you have earned income from a job, you can still possibly do an IRA contribution. If you are not working and do not have earned income, you could not contribute to an IRA. Now, there's other factors to contribute to an IRA, like do you have a qualified plan at work, what's your income levels, things of that nature. But generally speaking, you need earned income in order to contribute. If you have it and you don't need the money for the today, and you want to defer for the future, definitely take advantage of an IRA contribution at any age, as long as you've got earned income and you qualify for that special deduction. Larry from Punta Gorda, Florida. Do you believe in buying the dip? Larry, we always look to buy cheaper. I will say that if I interview 100 different people in a room or have a survey, and I ask individuals, when do you like to buy at the grocery store, when things are on sale or at full price, everybody will raise their hand and say, of course, on sale. If I look at the investment markets, again, the reason we would buy in a dip is because we don't see signs of a recession and we see signs of a growing economy, and we see a temporary pullback in whatever investment we are buying, but the fundamentals are still there. But if I ask that same 100 people in a room, when do you want to buy the stock market after it's dropped 20%, most people would not want to buy the equity market or an investment after it's down, in fear that it's going to go down more. Now again, if the fundamentals are still there, Larry, yes, I would be buying the dip. I like buying cheaper if we have the opportunity. We don't always get that, but again, fundamentals matter. What's the long-term growth of the asset and the opportunity that you're purchasing? Is it intact? Then I would definitely buy the dip, and it might be a great opportunity for your portfolio. Mark in Naples, Florida. What is the difference between REITs and non-traded REITs? Mark, you must have heard my comment earlier. There's a huge difference. Okay, first off, non-traded REITs are not liquid. Once you put your money into these, you cannot get it out until the REIT manager decides to sell, liquidate, and give you back your money. You may get more, you might get a lot less, but you have no flexibility. The problem with non-traded REITs, and I've talked about this for years, brokers love to sell them because it lines their pocket the most. It's bad for you. Traded REITs, you can buy and sell anytime you want. They're liquid like a stock would be. So if that investment you buy in a traded REIT all of a sudden has a change in fundamentals and you want to sell it, you could easily sell it. You cannot do that with a non-traded REIT. Also, non-traded REITs have big markups within your money that goes in. I'll give you an example. If you invested $100,000 in a non-traded REIT, the typical non-traded REIT haircut off the top of your $100,000 is about 18 to 20%. They take that away from your original investment. That's crazy. You could buy a traded REIT without any of that markup, and 100% of your money goes to work. So why does your broker or advisor like non-traded REITs? Because it's better for them. Look at a traded REIT, not a non-traded REIT. And if you were sold a non-traded REIT, another reason why you should call Rezny Wealth Management and get a second opinion, because your advisor's not working in your legal best interest. I'm going to take a quick break. Visit ReznyWealth.com. I'll take more questions after this. Hello, I'm Brian Rezny, president of Rezny Wealth Management. Is your broker working in your best interests, or are you being sold inferior investments by Wall Street firms and annuity salespeople? My advice, never settle for bad advice if you value your financial and retirement security. Real money management, real advice is the difference my firm provides. Call us today and schedule a consultation. I hope you're joining today's show, and of course, send us your questions to Brian Rezny at ReznyWealth.com. Make sure you visit our website, download any of our groundbreaking reports for free, and as always, Rezny Wealth Management, locally owned Southwest Florida office is right here in Naples and in Fort Myers. Call us, schedule a second opinion, visit our website. Never settle for bad advice. Don't be unhappy. If you're finding the returns that you are currently receiving are lacking, you're questioning the direction of your portfolio or the advice you're getting, call our office. Don't wait. Procrastination really can kill your retirement security. I know people often don't like change, but let's face it, when the advice is not working and you're questioning it year after year, it's time you called my firm for a second opinion. You'll be glad you did. Cy from Florida, what do you think of floating bond funds? Cy, we actually like floating bond funds. Let me explain. All bonds and bond investments are not necessarily the same. A lot of bonds are long-term maturity, 15, 20, 30-year maturity bonds. Some are short-term maturity, 90-day type bonds. When interest rates go up, bond values go down. We're in a rising interest rate environment, in my opinion, for the next 3 to 5 years if the economy keeps on the track we are currently projected to grow. That means you do not want to own long-dated or intermediate-term bonds. Nothing, in our opinion, under 3-year average maturity. Floating rate bonds work really good because they're short-term paper, usually 90 days. So as interest rates go up, your rate can keep moving up. You're not locked in for a long-term low rate. Your rate can correspondingly go up. And it has very little negative impact on the downside of the value as rates move up. So I do like floating rate bond funds, and I think investors who own the wrong kinds of bonds or have been sold the asset allocation by their advisor on the 60-40 split, you probably own the wrong kind of bonds. We see this every day in our office. Call us, schedule a second opinion. It's time to review your portfolio. Make sure you're on track so you can have the best retirement possible. Bill from Naples, Florida. Hi, Brian. You sound bullish for 2018 and long term. Aside from the risks you mentioned in your writings, are there any other boogeyman that people aren't talking about? Bill, there's always going to be some short-term corrections in all investments, not just the stock market, but all investments. So really, if I look at 2018, and I'm really looking not only this year, but over the next 3 or 4 or 5 years, with the current policies that are being implemented, whether it's the tax reduction on corporate, individuals, and so on, I firmly believe that we're going to see higher earnings growth out of the U.S. and U.S. companies. That's going to bode well. So I am bullish. I'm always cautiously optimistic. I will tell you that. If the situation changes, meaning the facts that we start getting 3 months down the road or 3 years down the road change, we'll of course change and we'll adjust our client portfolios because we're a money management firm. Never be married to what you think is going to happen. If things change and the facts are changing, then you want to change your direction of your portfolio and how you're invested. But right now, we don't see any really crazy things in the closet, if that's what you're suggesting. Normal volatility, expected, it's normal. But I do see growth in the U.S. economy the next 3 to 5 years if we keep on the kind of policies we're currently witnessing. I think it's positive for the U.S. and it's positive for other parts of the world. Dean from Fort Myers, Florida. Is it time to begin adding bond funds back to the mix? Dean, no. Let me explain. I talked about asset allocation that's pushed by the brokerage firms and banks and the insurance companies. That's usually 60% equities, 40% bonds. No. There's times, folks, you don't want to have any bonds. Maybe you should have 20% bonds and raise 20% cash. Remember, bonds go down when interest rates go up, and we are seeing interest rates going up. So maybe you want to raise cash. Maybe you want to change the type of bond investments in your portfolio from the traditional kind of bonds most of these firms are pushing. That's what I would recommend. Walt from Naples, Florida. When rates rise enough, will money be pulled out of the equity market? No. If the interest rates go up too fast, that could be a problem for the equity market, and maybe that would happen then. I see very slow, methodical changes in interest rates. Maybe this year we get 3 interest rate increases of 1/4 each. Not a big impact. I do not see Jimmy Carter day interest rates the next 3 to 5 years. Slow. As long as rates are moving up slowly, actually the equity market can do quite well, and historically it has done well in a slow rising interest rate environment. The big key is, does the economy continue to grow? And at the end of the day, that's the important thing. Folks, I'm just about out of time. Make sure you visit our website, Results, Retirement Security, and Peace of Mind. Experience the Rezny Wealth Management difference. My advice, never settle for bad advice. Never settle for mediocre. Never settle, period. Call my firm for a consultation. Schedule a second opinion. 800-618-8577, and visit our website, ReznyWealth.com. Make sure you listen to my live radio show on Sunday mornings from 10 to noon throughout Florida. Again, you can look at times and availabilities right at ReznyWealth.com. As I've always suggested, investors will often wait and suffer catastrophic losses in their portfolio or mediocre results until it's too late. If you're suffering or settling, don't settle anymore. Call my firm. We'll see you next week.